One of the big trades as we go into the back end of April has been the appreciation in the dollar. Now, fundamentally, there could well be a number of really good reasons to continue this trend. We've got expectations that the Fed's going to act possibly more aggressively than other central banks around the world. And also, of course, because of geopolitics, the dollar does act as this area of safe haven. But what about the technical analysis around this, and how fast, if anything, could we get actually down to parity, a 1-to-1 ratio between the dollar and the euro? Well, with more now from the technical side is Ron William from RW Advisory. Ron, welcome. This is a really interesting area of trade, and I know a lot of IG clients are talking about this and the speed with which the dollar has appreciated recently, and whether or not this trend is likely to continue. Let's pick up, if we can, on that and ask you to give your thoughts on this, and perhaps maybe start with a live chart.
Great opportunity to do so, certainly with the fast and volatile moves that we're seeing now. There's a mixture of drivers behind the euro-dollar move down. Essentially, it's the long-term 20-year technical breakdown that we'll see in our follow-up chart, coupled with the surging US dollar, geopolitical tensions, and the energy supply disruptions vis-a-vis Poland, Bulgaria that we just heard, and then the growth slowdown concerns further amplified with the China lockdown. So these are the market and macro forces in play. But if we look at the actual live chart right now on the screen, you can see that the impulsive drive down, multiple red candles pushing lower, and on the MACD looking a little bit oversold, but still oversold maybe for a reason and perhaps more to come. And if we zoom out a little bit on the same chart, Jeremy, it's the important context of the 2020 pandemic low, which is what we just punctured under.
Well, let's pick up now on that point you mentioned about the long-term pattern that's developing here, because if we look back and even a longer-term picture past pre-pandemic, there are some really interesting levels to watch out for. And I think that's the next area I want to discuss with you as to how good are those levels of support going to be?
Well, this is it. I mean, it's always a big question in terms of the general analysis and how robust it can be with big moves like the ones that we're seeing. And so whether it's trend analysis or key levels, and in this case, levels, it's important to look across timeframes, so short-term, medium-term, and long-term. And we can see here on the big picture, it brings all of them into one snapshot. And that pandemic low is the first green circle to the far right. But you can see there just nearby is a big multi-year level going all the way back to 2015, and actually further back if you have more data. And that is near 105. That is truly the make or break level for Eurodollar. And if that does have a sustainable break to the downside, parity will be an inevitability. We spoke about this some years ago, and back then it seemed to be, the cards seemed to be already positioned that way. But now we're only 7% or so away from that target, so not far away. And you can see that the 20-year trend breakdown. So that truly is the trend momentum weighing in, not so much being the friend in a bull market sense, but in the opposite. You can see the tidal wave kind of pushing most of the moves down. And there was a 17-year price zone breakdown as well. So a mixture of technical channels, key levels that are coming into question right now on the chart. And this is all part of a crisis pattern, which we'll see in the follow-up chart, last seen during the 80s and 90s.
Well, let's look at that then in some more detail, because that chart references something we have spoken about before, and it takes into account an even longer term picture from which I know you've garnered a lot of data, which gives you some further detailed analysis on potentially where this market may move. I'd like, if I can, to refer back to that longer term picture.
Big picture speaks of a thousand, and in this case, a million words. So we can see what is themed a crisis pattern, targeting parity and likely much lower on the updated schema. Essentially, the crisis pattern is showing economic growth and contraction behavioral patterns on Eurodollar. So growth on the way up, usually a 90 plus month duration, and then contraction on the way down, which is more of a volatile corrective wave. Now, we saw this, most recently, global financial crisis of 2008, that was the previous chart that we saw there in terms of the snapshot price history. But then if you actually go one big cycle back, it's the ERM crisis of 92. And this same chart that we looked at together, Jeremy, some years ago is coming right back into play now. History doesn't repeat, but it does often rhyme. And so we're seeing the event risk rhyme of markets. And essentially the parity level, by the way, on the 36 year trend support, which comes in at parity on latest charting, actually has already broken. It's just a quick disclaimer point that is important to make. So if you do plot this out on your own platforms and according to the data points that you use, that big line, that trend line has already broken. And so we'll just add further pressure to the downside into parity and even lower. And you can see there in the bottom window with the 16-year cycle that I've been following and the fractal pattern of that, the 45-year cycle, showing that there was some inevitability to this down wave in the Eurodollar move since 2008 up until now.
One of the questions, of course, that comes out, it's a fairly simple question, is how low can the euro dollar go? And I know when you introduce the next chart in just a moment, you're going to be talking about some technical analysis that I think in the classroom we've all learned, but for those that only dance around the outside of technical analysis might not have come across point and figure. I know this is one way to analyze the markets, but if I can ask you to introduce this chart using that analysis and talking about how point and figure works.
Yeah, so point and figure is a great classic price filtering system. It's one of the systems that I've used since the very beginning. It's great for actually identifying clear trends and most importantly, the breaks and the price projections that they will offer. So in the case of Eurodollar, it's very interesting because it will actually give lead signals way ahead of time, and that's what we have here on the chart of pointed figure. So it's unlike other charting in the sense that you'll see X's and O's representing rises and falls in a condensed chart space, but you can see there the trend is clearly down, and it was within a 7-year trading range, which is what we've just broken below, and the bearish price projection, or in point figure language, vertical price projection, is 97. So we can arrive at a similar price projection using different methodologies, but this one is one of the more tried and tested classic ways of doing so. And so that's giving us a very interesting target to keep in mind. And on the right, more of the macro risks that are useful to develop scenario for. So you can see there on the risk curve, the biggest tail risk is the big cycle risk that is highlighted on the bottom of the chart, bottom right, big cycle risk into second half of this year and 2023, which we've spoken about in previous interviews. One themed is the big cycle turning. That's the main one for people to watch out for. The geopolitical tensions that we continue to experience vis-a-vis Russia, Ukraine, and just the recent lapse with the energy supplies. Growth, peak, fall, which is naturally going to be overlapping with that. But there are other factors as to why that will continue, particularly in the Europe space. And remember what's happening with the China lockdown and how that will be specific to Europe too. And then last on the chart, you can see a debt crisis, which is the big shoe left to drop. Time will tell as and when that that can happen. But these are all risk factors. You can look at negative risk factors and positive risk factors, but here we're looking on the downside for euro dollar, so it's good to factor in what could drive that.
When we look at these markets, of course, we're looking at the entire market and everybody's involvement and taking the trade in whatever direction it is. What about the financial institutions and how are we measuring their expectations of where euro dollar is going to go?
Well, sentiment is a key driver for markets. I mean, investors' sentiment drive markets, and we can gauge it in different ways: surveys, money flow, option data. And interestingly, both speculative and option data is currently moving in line with the market move. Risk reversal data is turning. Options market traders are actually hedging with higher premiums now. But when you look at sentiment data based on the smart forecasts from leading institutions, there is a divergence. And so the big question here is it an intelligent group think expecting euro dollar to have a higher base at 104 by the end of the year, which is what we see on this chart? Or could this be a sign of a greater pain trade ahead, which could be a negative surprise for some of the professionals out there? So this is a probability distribution depiction of forecasts from institutions, and you can see there on the far left 104 and no lower than 104 is the worst case assessment, and then the mean is at 114 and the best case is at 132. So it's interesting gap there that we see between what financial institutional professionals see versus what's actually being priced into the market.
It's interesting as well, isn't it? When talking about the performance of the dollar, we quite often look at the euro dollar trade, and we're talking there about the target of parity. It's a nice, easy, round number to look for, and setting the markets and where we are and so forth against that is quite straightforward. But we mustn't forget, of course, that this dollar trade has been against a whole basket of currencies, against sterling, against yen, against Canadian dollar, Aussie dollar. They've all been really good, interesting trades to make, and those traders, we're constantly talking to people who want to find other ways of going long dollar. But also I want to take a look as well at what's happening with this dollar basket trade, because that is another well-known and well-tried and tested chart. What do you say about those that look for this broader cover in the dollar trade, and how important is the dollar basket?
It always has been. I mean, it's the global reserve currency. It's certainly the major currency block in terms of all the trades that we look in this space. And currently, right now, what we're seeing is the traditional SMAR relationship, where dollars bid if it outperforms other markets or currencies, and in a high risk situation, which is what we're seeing. And as you say, it's dollar outperforming, but that also means on the other side of that game theory, there are other currencies that are underperforming. And so the weighting of the index is more than 50% euro. So essentially, this is the mirror image of the euro down move, dollar up move. Japanese yen as well is in the second position, and then the pound. So we've seen the dollar appreciate against commodity currencies, when we're also seeing many of the European currencies underperform, partly due to what's happening with the geopolitical risk vis-a-vis Russia, Ukraine. So there's all different types of factors moving all at the same time right now that is just acting as a double whammy. So euro down along with other currencies, but also dollar up. And what we can see here is that multi-year range that we saw in the euro dollar, but the range was pointing down for euro dollar, now up for dollar index, pointing to a potential 20-year high if we get a breakout above this level. So that will be further upside to see. And as you mentioned at the very beginning there, prospects of rapid Fed hikes will add further rate differential widening, and that will be further upside for the dollar. So interesting to see what happens. And looking at the macro perspective as well, this could be a deflationary story if the dollar was to have a sizable move to the upside, where a lot of the commodity moves that we've been, asset price moves that we've seen finally correct and shake out, but also even the commodity side of things also start to unwind. So thinking of oil, we looked at, we had a brief discussion as to how that could be a big short opportunity and how some of the other commodity complex could also unravel.
Ron, thanks so much indeed. Interesting story, and we'll see how things develop over the next few months or so. That's Ron William from RW Advisory. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.